Ladies and gentlemen, welcome back to Living Markets with Liberty. This being the first episode of 2026. I'm delighted to be joined again by John Taylor, actuary and investment expert at Liberty Corporate Benefits. John, welcome to 2026. You're looking no older than you did in December 25.
Thanks so much, Leon. Great to be back with you.
So we had a 25 of notes. I was looking at some numbers the other day, and I just find it astounding, some of the returns on the gold shares and how the market has continued to go up. And I keep on looking every single day because we publish in our newsletter a little summary of the market, and it's either green, red, or white. And the green persisted. And this year started off with a fair amount of green as well. And I keep on wondering, how long can this continue? And I was actually having a discussion with our CEO earlier, and he was talking about how he feels that there'll be some mean reversion from the shares that didn't do so well. There'll be a bit of catch up, and therefore the overall funds will continue to benefit in that respect. But I think before we get into talking about the future, because I actually am going to put both of us on the spot, and we're going to make some predictions that we'll come back to in 12 months' time. But before we get to that, John, can you please give us an overview of what happened in the markets over the course of 2025, both from a market perspective across the world and in South Africa, but then also from a asset manager or pension fund perspective?
Sure, Leon. It was fascinating. You look with this stuff all the time, but then when you actually sit back and say what happened during 2025 from a market point of view, yes, I knew the numbers were big, but when you actually sit back and look and say the JSE went up over 40% at an all-share level. So that means that you pretty much could, not while I've been working, have I seen those numbers. I certainly know that the last time we saw those numbers were kind of 20, 25 years back. So 40% out of the JSE, it means your kind of 5-year numbers are actually tracking at closer to 18% a year. Okay, 18% compound a year for 5 years is like 80% up. So incredible numbers, and it's not just equity driven, and it's not just South Africa driven. I mean, obviously the gold shares, your resources have done extremely well, but your financials have re-rated quite nicely through the course of last year. I think a lot of the initial jitters about the GNU came off, and even though we still have jitters, I mean, by no means is the GNU confirmed and in place safely. But we're in a space where everything's running up despite some market sentiment or geopolitical concerns. And in some cases, obviously, things like gold and precious metals are up because of a lot of geopolitical concern. Bonds in South Africa up nearly 20%. That's in spite of the fact that actually real rates or nominal rates have started to ease globally, and despite the fact that your kind of credit rating in South Africa has improved. We saw some credit rating upgrades last year. I think it was from S&P. You then also have the fact that global equity, despite the fact that was the one we were worried about in rand terms because of how strong the rand was, that's still up over 20% in rands. So it's very hard to say there was a weak point in the market. Even property continued its march upwards. That was up nearly 35% over the calendar year. So, yeah, boom times for the calendar year 2025.
So the real question is, can the markets sustain this? And again, there are pockets within the market that haven't rallied to the same degree. So there is, perhaps my boss is right, there's some catch up that's still to take place. But also, we always speak about bubbles, and it's quite clear if you have a look at tech stocks in the US, there's a bubble that is created. But the reality is that, and I actually want to poke a bit of fun at you and actuaries, because you actuaries always talk in your modeling about equity risk premium of about 3 to 4%, or maybe not even that's that high. Well, you sure as hell got it wrong over the last 5 years, guys, because the premium is multiples of that. But can we use the same methodologies that we always have, the same thinking, when it comes to assessing these bubbles? I mean, can you look at a Tesla and a Google, given the AI revolution that's taking place, and say the valuation is, toppish?
Yeah, difficult. I mean, any kind of new technology, very difficult to call exactly what that means for earnings going forward. I did an interesting piece of work, oddly enough, powered by a little bit of AI earlier this week, where I tried to have a look at the price earnings ratios, both for South Africa and for the US, and really comparing current to on a standardized basis. So in other words, looking kind of on a normal basis over the last 25 years to say, are South African shares expensive? Are US shares expensive? And relative to each other, are they expensive? And not just to their history. And the answer that you get back is that US earnings, certainly on a trailing basis, actually have tracked higher at the same rate that their prices have moved upwards, which implies that they're not actually as expensive. Now, the magic trick is you need to know the future earnings, not the past earnings. And that's a bit more difficult to tell. Um, but certainly on the basis that even in the tech space, earnings have tracked higher over the last 2, 3 years. It implies that, yes, it's hard to argue that those shares are cheap or even fairly valued. They look very expensive, but their earnings are not massively behind at this very early stage of the game.
You take Tesla. I mean, like to sit there. It's not like you can say, well, we're going to sell 20% more because there's greater demand. I mean, they are about to launch the autonomous driving vehicle. I mean,
Yes.
that has the potential to completely change the world. They talking about producing 300 million Optimus robots, AI-powered robots. I think the time was not before 2030. They're assuming that each human being will own at least two of these robots into the future. I mean, if these numbers are right, I mean, it's multiples the earnings that they could
Yep.
possibly. So it's making it awfully difficult to assess things with the lens that we've always used. But
Yep.
therein maybe lies the biggest fault we ever make is we always think that the new world is justified in some way where maybe the new world is just a little bit crazy.
Yeah. And I think that's the fine line we walk between underestimating the impact of this change in technology on how we're going to live in the future and how economies are going to work in the future. Um, but at the same time, not falling into the trap of saying this time is different, because this time at some macro level is never different.
Yeah, and the other one that I've always told you could set your watch on the fact that the rand would depreciate. So if you wanted to make a bit of money, put it offshore and you will benefit. And I'm sure a lot of people are sitting and saying, gee, we've diversified as pension funds significantly offshore. So
Yeah.
sure, the markets have still done well in rand terms, but the reality is the rand's back to levels, I think, of 10 years ago.
Yeah.
And you think, how is that actually possible?
So I think that talks to two kind of things. The one is the short-term movements of the rand. That's a dark art, and it isn't tied to economics. There's a lot of sentiment. There's a lot of other factors that play. The other bit to it, it says that, that old logic that the rand will always weaken, that relied on the fact that your inflation differential between South Africa and, for example, the States or Europe was always going to be positive towards South Africa. So in other words, the rand would weaken over long term in terms of purchasing power. In reality, inflation rates between South Africa and the US have converged to a very similar number over the last couple of years, which would imply that you shouldn't, all factors equal, see that kind of um, weakening coming through to the same extent. And obviously, there are very specific factors to the US around why their currency is weakening as rapidly as it is. There are also very specific factors as to why the rand looks stronger on the back of the fact that things like gold have run so hard.
So That's the backdrop, and we've had good news in South Africa around some of the ratings upgrades coming off the grey list. Our inflation numbers, we're targeting 3%. The inflation numbers that have come through, starting to see the inklings of economic growth, still not at a level that is sustainable to solve a lot of what South Africa needs to solve for, but there is positivity coming through. How's the asset management community? And I've always found this a fascinating question because I'd always ask asset managers at the start of the year, what do you expect this year? The question I'm going to ask you a little bit later. And they always give me the same boring old argument of around about 10 to 15% from equities. So they go back to their varsity textbooks and they work it
Yeah.
from the interest rate to answer the question. I'm looking more for an emotional answer than a textbook-driven answer, but we'll get back to that later.
Yeah.
How's the asset management community seeing the world at the moment, and who's doing or who did well and who did less well last year?
Cool. So, Leon, number one thing, that old saying, a rising tide lifts all boats. Well, all boats got lifted by the fact that virtually all asset classes at some broader level have performed really well relative to inflation. So that patch where we went through from kind of 2014 to 2021, where nobody could beat inflation plus targets purely because equities in particular couldn't give you CPI plus 2, 3, 4, 5. Now, all of a sudden, obviously, if equities are giving you CPI plus double-digit numbers, then that also is a little bit more meaningless. So it's important to keep it in mind longer term, because fundamentally we need to compare the performance of these assets to something that the liabilities or what we're promising to deliver to investors will do. And that's just the inner actuary in me coming out, I guess. The reality is that the asset managers who got it right in terms of precious metals, particularly gold, and platinum as well more recently, and then the guys that got it right in terms of the SA Inc. story panning out quite nicely. And that's, I mean, two factors that resulted in somebody like Alan Gray doing really nicely last year. They were quite well positioned relative to the gold miners in particular, really well positioned to the banks. And that's why they kind of banked on a GNU kind of SA Inc. success story that worked for them largely last year. Somebody like a Coronation should, I mean, that they should fly the fastest in these kind of real growthy, almost growthy with no basis markets, which is kind of what in some ways we've seen. They've done well. I mean, in absolute terms, you wouldn't cry. But obviously, they are behind a couple of the peers. And that's just timing. If you're not in the precious metals that you were wanting to be, and particularly in the middle of the year when everything kind of rallied 50% up in that resources space, you missed out. So just at a high level, those were some winners and losers relative to each other.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.
Who are the guys that stand out that haven't done that well? I mean, who's sitting towards the bottom of the tables?
When I have a quick squiz at it, somebody like an M&G, a little bit behind where you'd like to be, Stanlib a little bit behind where you'd like to be, Old Mutual a little bit behind where they'd like to be. Somebody like a 91 who have battled quite a bit kind of through 22, 23. Their 24 was a bit better, their 25 was okay. And that obviously has knock-on effects to some of the businesses that they manage for. So in general, your big kind of independent names, that old FICA, as we used to call it, 10 years ago, your Foots, well, not so much your Foots, but your 91s, your Coronations, your Allen Greys, they all actually did all right last year.
And the boutiques, because when last I looked, the boutiques were starting to poke their heads up above the rest of the crowd. Has that continued? Are we seeing some of these
Yeah.
new boutiques coming through?
Some of the boutiques have done well. I don't have specific names to talk to right here with me now, but in a market where you have some smaller counters that have done really, really nicely, if you were able to take more than what the big names can position in some of these mining companies and some of these SA, well, less so much SA Inc., but certainly the mining counters, and you weren't constrained into the top kind of 20 or top 40, and you actually did quite nicely. I mean, some of the guys, as usual, if you time Naspers right, and remember Naspers and Process ran quite nicely, especially towards the back end of the year as the China story looked a little bit better, then you did quite nicely.
So I was looking at some research the other day. I mean, if you have a look at the 10 largest asset managers in South Africa, they cover nearly 2/3 of all assets managed, essentially. And when you look at their size and you then look at the JSE, it's quite difficult for them to meaningfully invest outside of the, say, top 40 stocks that are there. The smaller guys do have more flexibility. Flexibility doesn't always mean better results, but what it does mean is difference. So when you ultimately look over the longer term between the boutique managers and these larger managers, performance has converged between the two. They're pretty much sitting neck and neck. What is different, though, is that the emerging managers give you a different risk profile. And that's interesting, because if you start looking at it from a perspective of blending a solution together and you want to manage risk, it's good to have exposure to some of those boutiques, not for everything, but to some of those boutiques to protect you when markets do things that are, perhaps not expected, kind of thing. So I think that's quite a useful observation that I took from that. And there was another point, but it'll come back to me. But it's just, to me, the point that I was going to make is that we always forget that the 91s used to be the Investec Asset Management, and Coronation used to be Cyfritz, and Alan Gray nearly closed their doors down in the 90s. They were the boutiques.
Yeah.
And the boutiques eventually do break through, and I think we're starting to see an inkling of that with the 361s, the all weathers. There's a couple that are coming to the fore, and there's a long list of them that people can benefit from as well.
I think that's the thing, Leon, is there's a long list and we'll see some consolidation. Not all of them are going to break through. As we've discussed in the past, the landscape will change. There'll be some consolidation and mergers and acquisitions, but you will also see some of those names becoming household names, and swallowing up some of the names that we consider kind of household brand names today.
Yeah. So if I was a pension fund trustee, or if I was a wealthy individual and you were my advisor, nothing changes. It's pretty much more of the same. Am I correct?
This boring advice remains so boring, I'm afraid. Yes, the science hasn't changed, the logic hasn't changed, and it's really in these very heightened market conditions against an extreme global socio-political uncertain environment that you must stick to your knitting. And that's the reality. So it's very easy to get distracted by what's going on in the Middle East, in the North Atlantic, in South America, all over the show, and think that somehow the fundamentals of investing have changed. We live in a world where, yes, oil is a massive factor, and obviously there's a lot of uncertainty around Venezuela, around the Caribbean, around, as I said, Greenland, Iran. All of these things, in theory, are scary for the oil price, and yet the oil price remains very much under control. At the same time, you do have uncertainty coming through in the pricing of things like gold and silver and precious metals, platinum even. Though a lot of that is good for South Africa, just kind of by nature of where we positioned and how we positioned. But we still face some severe socio-political challenges. Our standing with the states is weak, and we're hoping that we kind of almost slip through in the AGOA renewal with everyone else because everyone's focused somewhere else. We know that AGOA passed the House of Representatives about 2 or 3 days ago. We wonder what will happen in the Senate. And remember, all of that still gets signed by the man in the White House. So whether we skate in, or whether we are going to feel some of the heat for the fact that, for example, we continue to proceed with war games with countries like Brazil, Russia, and of course Iran would be the hot topic, and whether Iran comes or doesn't participate or rest of it. So a lot of those kinds of tensions will continue to dominate, I think, the South African agenda, besides the fact that we actually are having local government elections towards, in theory, the end of this year, maybe early next year, I believe. But all of that is going to play into the national psyche. But I think it's going to be global factors that are going to drive a lot of what we're going to see this year more than the local news.
Yeah, I think, look, obviously wars are not good for the oil price, but because it's drill, baby, drill, and what's happened with Venezuela, I think that Trump has to keep the oil price down. He has to get it down because of his inflationary issues.
He has to keep the oil price down because he has to manage inflation. His biggest risk in the midterms, which also are just 10 months away now, is around the cost of living. That's why you see what you're seeing with the central bank there, the US Fed and Jay Powell. So all of that's playing into the fact that the single biggest risk to the Trump administration is the economy, and I guess that's a lesson to be taken, that US voters vote on the economy and pretty much only on the economy.
But I still think from an advice perspective, and obviously this is just advice, and it's discussing it. We're not giving the actual advice. But if I'm sitting with my parents, or if I'm advising a fund, I'll be saying, right, your general structure, it's about your liability, it's about your term to when you need to cash in, doesn't really change at this point. Nothing's changed in the fundamentals to say you need to revalue this or do that or drop the equity risk premium or whatever it be. There's no reason to do that. But because there has been, call it, excess that has come through, all right, it is about risk management. So first of all, the rand is looking strong. Yeah, maybe it will continue, but you should be fully invested offshore if you can, to the full degree that you possibly can from a diversification perspective. You should be looking at your manager lineup and saying, right, do I have or can I build in more flexibility in order to manage risk? So look at some of the boutique guys and give them a fair swing at it in terms of your overall portfolio makeup and so on. But then also pension funds, individuals, very little in private markets.
Yeah.
Diversify a bit, private markets, 5, 6, 7, maybe 10%, whatever it might be.
Yeah.
If you've got the longer term tolerance to see out illiquidity and so on. And those are wise things ultimately for investors to do, not from the perspective of chasing return, but from the perspective of when perhaps there is a bit of excess, that we manage risk in a better way.
Yeah, and I think, I mean, so many points to unpack there. I think let me start from the kind of private market assets point first, because I do think that it's particularly in these heady markets that finding assets that you can get exposure to that aren't marked to market, that you can really focus on economic value from. And remember, private markets don't necessarily imply that, they don't imply at all that they're lower returns. In fact, often you get a premium for the fact that you don't have listed kind of listed kind of characteristics, that marketability, that liquidity, all those good things. So if you can find a few assets, and again, diversification is key in that space, that you can allocate to, it removes some of the day-to-day noise of what's happening in the world and focuses purely on the economics of that wind farm, kind of hospital, whatever your project is that you're investing into, that you can get economic exposure to. So that's one aspect. Jumping back to the point around, sticking to that diversification across management. And it's also about, as a pension fund trustee or any fiduciary, and it's about saying, how am I making sure that I'm taking advantage of the opportunity set that's available to me? And When you look at the JSE, obviously one of the key concerns we've all had is how many listed shares are available and just the liquidity of the available shares on the JSE. And that's dwindled over the last 20 years. And that's been a major concern. And that's opened the door for the fact that private credit, private equity, and even hedge funds become viable additions to your strategy. The second thing is to say there does seem to be some hope and enthusiasm and seemingly some plans towards getting more shares onto the JSE, easing some of the requirements in some spaces. That kind of deregulation talk or ease of doing business talk is obviously something that, as South Africa, our institutional investors and our businesses have been crying for a very, very long time. So if we can see some of that without removing guardrails on good corporate governance and the like, that would be a really, really positive step.
Yeah, that's sage advice for sure. So, John, 2026, okay, prediction time.
Yeah.
And we're going to have you back here this time next year, and there will be a wager of some sort. So, what percentage are you guessing, you can put it that way, your educated guess, from equities in South Africa?
So, as much as I would warn people not to expect this all in a straight line and do expect drawdowns to occur during the year, I think the JSE all share can hit 140,000 this year. So that would be about, call it a 15-20% return on the JSE. On the all share, I think that I'll even make a RAND prediction. I never make RAND predictions.
I'm going to ask you for your RAND prediction. That was next.
I think that the RAND probably, it will hover in a very large band, not in a tight band. It will be quite volatile, but I think we can be around the $16 mark. I don't see why we don't end the year in a similar spot.
Okay. And then the final one, then I'll give you my predictions for what they're worth. But the final one would be how many interest rate cuts or increases are you expecting?
Oh, wow. And in a world where these interest rate cuts have become so politicized of late, I think we'll see our Monetary Policy Committee cutting rates probably 3 times, 25 each time, so 75 in total.
Okay, so my predictions are going to be 2 interest rate cuts for the year, so we're not mild or madly off there. I think the Rand's going to end up back at about 18 or 19. And I think that the first half of the year on the equity markets is going to be bullish. And I think something's going to rock us in the second half of the year, and we're going to end up somewhere between 8 and 10% up overall, which is still not bad. But I do think that something is going to, knock a little bit of sense into us at some point in time.
I'm glad there's a bit of a gap. One of us can be right, one of us will be.
I will be documenting all of this. Plus, it'll be on the internet for all to see and hold us to it. John, thank you so much for joining us again. We have an episode every month that we're running in the series of Living Markets with Liberty. So again, a big thank you to Liberty Corporate Benefits for their sponsorship of this series. It's particularly useful for all people in the retirement and financial advisory industry. So it's good to have this conversation with you. We will be having some guests this year as well. We're going to spice it up a little bit and invite a couple of guests throughout the course of the year. And we've defined a couple of key topics that we're going to be covering across the episode. So I'm looking forward to further discussions with you and also with some of your colleagues at Liberty Corporate Benefits as we move forward. So big thanks to you again for joining us, for your wise words and hopefully your wise predictions as well.
Thanks so much, Leon. I appreciate it.
All the best. See you next month.
Thanks. Bye.
Bye.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.